we do as a foundation is to really look to the future and to see how we can still affect the institution or families or churches or whatever. What can we continue to do after we leave Earth? And so that's why plain giving is important for everybody. One example that just happened that and I'm not going to use names or the situation necessarily, but we worked with a gentleman that's not an our alum, but that had a business that was nationally known, doesn't even live in Springfield, but the estate that he has is a lot of land, a lot of buildings, and I won't even tell you what he did do. But there was a connect with us, with the institution for education. And what he did do sort of relates to education, and he had a passion for his passion to continue, and would it benefit our students? Well, in this case, it would. And it's an incredible gift. And we've talked for years about this gift, and he said he would like us to, when he passes, to all that estate coming over to the institution so we can continue his passion. And we've talked about this for years, and now this just happened a few weeks ago. He did have a will. Now we encouraged him in this. Of course, we're not attorneys. Emily is, but we're not attorneys, but we encourage him to do a life estate. So when he does pass, then we don't have to, he doesn't have to worry, his family doesn't have to worry. It comes over to the institution, and his passion for what he does will continue forever as long as Missouri State is here. And he's still young. He was 70 some odd years old. He just passed a few weeks ago. And he knew he had some health issues, but something happened in the last few weeks. And he made a few changes 48 hours before he passed. And so I say all that is it wasn't clear and cut. It wasn't a retained life estate in terms of that. So we will have to go to probate. We will have to go through this whole process. And that's not what he really wanted. He wanted the outcome to benefit students and to have his legacy live forever. In this instance here at Missouri State. I wish he had not, I wish that person would have done and worked a little bit more closely with the attorney to get this solidified. Now, I think it's still going to work out, still going to probably take a year and a half or so to go through the courts. We still have to probably go through the court system. Doubt it's contested, but it's not what I know what he wanted in his heart. That's not really what it in his heart. He wanted this to automatically happen. So I say all that is that I don't think he thought he was going to pass away. and we can give a million stories about people. Yeah, I remember Ken Meyer, who the name of this building is, thought he would live till he's a 101.3 KTXR. He always said that, and he didn't. Mr. Hammonds, I don't think ever thought he would pass away, but he did. But we all have to pass away, but we want our passions. We do want to give a legacy to our family, to other organizations. So this stuff is really, really important. And I wish this gentleman, we could have had some more conversation, said, let's really get this solidified. So your passion will continue. So this is, I think, just to talk about other plain giving vehicles, to really use it as a service, but the passion and what you do in your life, how you can make a difference in your family's life and lives of other organizations will continue. And that is a noble thing. And that makes a life well worth living. So thank you for being here, and I don't know, we turn it over to Carl, and we'll introduce Emily, and we'll go from there.
Thank you, Brent. And so this is the first one of our seminars that we're going to do. Emily is going to be nice enough to do more of a 50,000 foot view of plan giving and estate planning. And as we do these seminars more often, we'll zoom in into specific topics that you all might be interested in. So without further ado, and I've got Emily's bio here, so I apologize, my old eyes don't work well. Emily is a partner with Kirkland Woods Martinsen. She focuses her practice on estate planning, trust and probate administration, transfer tax planning, issues related to business succession planning, and adult and minor guardianship. She's a fellow in the American College of Trust and Estate Council. She's a Springfield native. Her husband is an alum, has 2 kids, received her Bachelor's of Science degree from Texas A&M, and where she graduated summa cum laude, and then graduated with her JD and LLM in taxation from the New York University School of Law. So let's welcome him.
Well, thank you and good morning. I appreciate you all being here today. I told Carl I don't love the mic, but I'm using it for all the Zoom people. So again, I'm sorry for the formality with you guys, but I hope that we can make this a conversation. I want to make sure that I'm answering and responding to some of the questions and thoughts that you had coming into the meeting this morning. And should you have any additional questions following the meeting, please let me know. I'd be happy to give you my email address and contact information, and you can reach out to me with any additional questions that you might have. But I appreciate being here with you today to talk about a topic that's very important to me, which is planned giving. I am an estate planning attorney, and I do try to advise all of my clients to consider charitable giving as part of their estate plan. It's very important. If you read the newspaper, you've probably seen that unfortunately over the last couple of years, charitable giving across the country has declined quite a bit. And so we are here to help change that, to change the pendulum back the other way. So we're going to get started here today and talk about some of the techniques that are available to us in order to help our favorite charities such as Missouri State. So let's start here. So there are some things that are extremely simple and some things that are a little bit more complicated that you might need an attorney for. But we're going to start off with the really easy ways to benefit charities, and that's with outright gifts. This can be done during your lifetime, something as simple as making a cash donation or making gifts of appreciated assets such as stocks and other securities, real estate, things like that. And that really helps you as a taxpayer avoid a lot of the capital gains taxes that would otherwise be payable by you during your life if you were to sell the property. So that's something to really think about. It's something very simple, but anybody can do. Oops. This is very touchy. Okay, so next, as Brent said, unfortunately, all of us are going to pass away. And I always joke that I have the ultimate job security because everyone's going to die and everyone has to pay taxes. And those are the 2 things that I specialize in, unfortunately, or fortunately, I'm not sure. My 2 kids are always asking me now, what do you do again, Mom? You talk to people about dying all day? Yes, that is exactly what I do. But one of the things we talk about is, where do you want your assets to go when you pass away? You can't take them with you. And so you have estate planning documents in which you set forth your wishes and directions as to who should receive your assets upon your death. And there are key estate planning documents such as wills, and you've probably heard of revocable trusts. And those are pretty key estate planning documents that most people should have in place to set forth your wishes. But some people don't realize there are other documents that are not necessarily prepared by attorneys that are legal documents and are just as important to set forth your wishes, such as beneficiary designation. If you have a qualified retirement plan account, which we're going to talk about a little bit more in a moment, those beneficiary designations would trump what your will or your trust says. I'll repeat that. So If you have a beneficiary designation that lists a beneficiary such as a spouse or your children, and your trust says something entirely different, the beneficiary designation trumps what your estate planning document says. So it's a very important piece of the puzzle. And your estate planning attorney should be very instrumental in helping you complete that form. In fact, that's actually something that we do at our firm. We ask people to supply us with that form and we help them complete it. But it's a great way to designate charities to receive a part of your estate at your death. All of these things that we're talking about are revocable. So when you do a trust, when you prepare a will or you sign a beneficiary designation or even a beneficiary deed for a piece of real estate, for example, those are revocable gifts. And so if you decide to change your mind prior to your death, you have the ability to do that. Some of the things we're going to talk about in a moment are irrevocable, but a lot of these things are revocable. So you're not signing in blood. It's something that you can change should the circumstances change over time, which we all know that tends to happen. When you do designate a charity under your trust, will, or beneficiary designation, you do not receive any immediate tax advantage or benefit. That happens upon your death. So and that's because it is a revocable gift. So if you designate the charity under your retirement plan account, for example, you do not receive an immediate income tax deduction for that because it's not effectuated until you've passed away. So that's something to kind of keep in mind as well. Okay, we'll move on. So one of my favorite ways for clients who are charitably inclined to give away their assets is by the use of their qualified retirement plan accounts. And honestly, for a lot of people, that's a very large percentage of their overall net worth. And I'm talking about things like IRAs, whether it's traditional IRAs or Roth IRAs, 401ks, 403bs, 457 plans, all of those types of accounts. And those are, for the most part, tax deferred. So you don't pay taxes on those assets until they're withdrawn at a later date. And you've all probably realized that at some point you have to pay the piper, right? So at some point the government says, you've deferred your taxes long enough, you've reached a certain age that you have to start taking what's called required minimum distributions, or RMDs for short. And they keep pushing that age back. Now I think it's around age 73. And after that time, you must take a certain percentage of your retirement plan account assets out. And then of course, at that point, you pay the taxes on that distribution. So as one of my law partners likes to say, those plans are pregnant with tax liability. And at some point, you have to pay. So unlike individuals who have to pay income taxes, charities do not. So there's a lot more benefit to a charity to receive tax deferred funds than to an individual such as a child. So if you're thinking, I want to benefit a charity as part of my plan, the most efficient asset to use is a tax deferred account. Does anybody have any questions so far? Okay, great. So you can name a beneficiary, straight up a beneficiary. You can say a certain percentage, for example. You can name your trust, and then the trust flows through to a beneficiary. There's lots of different ways to do it, but each has a different tax effect. As I said, that beneficiary form is a legal document, and it's very important to work with your attorney to make sure that you've written it correctly, because even a little difference in how you fill it out can make a big difference from a tax perspective and can cost a lot of money and headache for the beneficiaries later on if it wasn't done correctly. So it's a really important way. And for those clients, again, most people are charitably inclined. If you're going to give money to charity, it's because you have a passion for that charity. You want them to benefit. But there's also the added benefit of an estate tax deduction for your estate upon your death for any assets that go to a charity. What I mean by that is the government likes to take a chunk of your estate at your death. And that is a large chunk. It's a 40% tax that's called an estate tax. The good news is most of us as US citizens do not have to worry about it. And that's because currently we have a very high exemption from estate tax. So unless you have an estate that exceeds $13.61 million currently, you do not have to pay an estate tax. But to the extent your estate exceeds that amount, everything over that exemption is taxed at 40%, which is a very large, very high rate of tax. And that's per person. So if you have a married couple, they would have to have an estate that exceeds $27 million. The thing is, don't tune out too quickly because most people say, well, that doesn't apply to me. The estate tax exemption amount is slated to be cut in half in less than 2 years. So on January 1st of 2026, it's supposed to go back down to about $7 million per person. And of course, that remains to be seen what happens. A few years ago, President Biden proposed bringing that down to $3 million per person. So it's always on the table. We don't know what's going to be at our desk. We don't have a crystal ball. So I always think it's important for everybody to understand that this tax exists and there are ways to plan for it. One of those ways, a very easy way, frankly, is through charitable giving at death. It's a dollar for dollar deduction and it is unlimited. So someone with $1 billion, say a Bill Gates, for example, he actually has several $1 billion, he could give all of his money to charity at his death and there would be absolutely no estate tax owed. It's the only voluntary tax. Now, most people don't want to give 100% of their assets to charity, right? But it is a way to reduce significantly the estate tax that would otherwise be owed at death. For those of you that have a sizable estate, it's something to be aware of. And there are different ways to plan for it. We're going to go back to not death. We're going to go back to life for a moment and talk about something called qualified charitable distributions. I'm just curious, by a show of hands, how many of you are familiar with what a qualified charitable distribution is? Oh, good. Okay, there are quite a few of you. I'm going to just go into it because I think it is a really wonderful planning technique that a lot of us can use. So basically what this says is if you are at least 70 and a half, you have the ability, if you have an IRA, you have the ability to take up to $100,000 a year of your required minimum distribution. Remember, that's the amount the government forces you to take at a certain point, and say, I don't want it. I want to send it to Missouri State. Bypass me, do not pass go, goes directly to jail kind of thing. It doesn't come to me first. It bypasses me altogether and goes to the charity. And by doing that, I do not have to recognize any of that income, which is very different from if I get the distribution and I turn around and I write Missouri State a check. That's very different. And that's because I don't get a dollar for dollar deduction. I'm limited to a percentage of my adjusted gross income. I will get a deduction. It just won't be a 100% deduction. So in order to get the maximum tax deduction, I instead make a qualified charitable distribution, which says, don't come to me at all, go directly to the charity. So that takes some forethought, right? And you have to actually make some plans and talk with the charity, with your IRA administrator to do that. And it can be to multiple charities. It can be a percentage of your required minimum distribution. So you can take some of it and then the rest of it you can send to charity. But whatever it is that you send to charity, it doesn't even get recognized on your income tax return because it's a dollar for dollar deduction. So it's a wonderful way to benefit charity. And as I said before, the charity does not have to pay any income tax on it either. So it's a very efficient way to make charitable gifts. Now, there is also a way, they just did this a couple of years ago, or actually last year. you have the ability to make a one-time gift of up to $50,000 if you're at least 70 and a half again. And instead of just giving it to a public charity, you have the ability to direct it to a charitable gift annuity, which we're going to talk about in a moment, or a charitable remainder trust, which we're also going to talk about in a moment. Those are two charitable gifting vehicles that are a little more complicated, but it used to be that qualified charitable distributions could only be made to public charities like Missouri State. Okay, so this allows you to help yourself or another person as well as ultimately benefiting the charity. So we'll talk about that. So there is some more flexibility with it, but if you leave here with one thing today, please remember qualified charitable distributions are a gift from the government, and we should definitely take advantage of it. You do need to ask your IRA administrator to give you something, basically it's a substantiation document that you then give to your accountant, because otherwise there's nothing automatically generated showing that you made the distribution. But you need to have that, give it to your CPA, and you'll be in great shape. But that's something you can do every year when you're a little older. So another type of gift, another type of asset that many of us have, in addition to having qualified retirement plan accounts, is life insurance. Or maybe you don't have life insurance, but you're young enough to where it's still relatively inexpensive, especially term insurance. So that's another great way to benefit Missouri State University or your favorite charity. And that's by purchasing life insurance, and you can either transfer ownership of the policy itself to the charity and continue to make premium payments on it, or you can own the policy and designate the charity as the beneficiary. But either way, at your death, those assets will benefit your favorite charity. And that's a very simple estate planning technique. Frankly, you don't really need an attorney to help you with that part. So I'm trying to give you some easier ones too. Does anyone have any questions about the life insurance part? Do we have any? Flag me down if there are any online. Oh, good, there is one.
So this question is from Lori. She says, I'm aware that QCDs need to go directly to the charity, but do some IRA gifts have a way to let donors write checks out of their IRA and send to the charity?
So I'm assuming everybody heard that question. Do you think the other people on Zoom heard the question? Or should I repeat it? Okay, they did. Okay, great. Sorry, I'm just wanting to make sure I'm not leaving anyone out. So you can't, unless you're at least that age, you cannot do what was just described. So that's unfortunately not permitted. You cannot write a check out of your IRA and directly to a charity. So you can withdraw money from the IRA, pay taxes on it, then turn around and make a donation and get a deduction. But clearly that's not as efficient as a qualified charitable distribution. Does that make sense? And you can't take any money out of your IRA before we change 59 and a half, or you'll have to pay a penalty. So this is a planning technique that really works when you're a little older. Good question though. Any other questions? Okay.
I have
Yes.
one. So you're talking a lot about estates and trusts, but could you do the same thing by just making everything POD?
POD, transferable on death. So the short answer is yes, with certain of these assets. So life insurance is an example, and that's really not a POD, but it's essentially a beneficiary designation. You can do the same thing with your qualified retirement plan accounts. So that's a beneficiary designation where you can directly name a charity on that. You do not necessarily need a trust or a will to effectuate that. Some of the more complicated techniques we're going to talk about in a moment, such as charitable remainder trusts and things like that, that's a little bit more involved and advanced, and a simple beneficiary form wouldn't suffice for something like that. But if you want to just name Missouri State University, 50% of my IRA, that's it. You don't need a trust for that. You might need a trust for other things, but not for that. Does that answer your question?
What would you need a trust for then, just in general?
So I'm gonna go off script for a moment. But a trust is really helpful because it allows you to be a little bit more detailed in exactly what you want to have done. You can't actually fit all of that detail on a beneficiary designation form. Does that make sense? So a lot of the what if scenarios. So for example, especially with non-charitable things, perhaps you have children, you want to designate that their inheritance continue in a trust for their benefit, not necessarily an outright gift. Does that make sense? You want to control the distribution to them over time. You want to put someone in charge of who's supposed to sell the assets or manage them for someone's benefit. Perhaps there's a minor child, someone with substance abuse issues, creditor issues, going through a divorce. There's all sorts of reasons why it may not be a good idea for a particular beneficiary to inherit the assets outright. And so in that instance, having a trust, for example, where you set forth all of your wishes is very important. Plus, a trust helps you deal with the what if scenario. So if let's say you name your children as beneficiaries and a charity. Well, if your children don't survive you and their children, your grandchildren are minors, having a minor inherit an asset can not be the best thing in the world, because then a conservatorship would have to be opened in the probate court until they're 18, and then they would receive the asset, which maybe age 18 is not exactly the ideal age for someone to receive a lot of money. So there's a lot more ways you can direct that those assets stay in trust for them for a longer period of time with a revocable trust agreement. Okay. Yes, sir.
How long has that rule about 18 been in effect? I mean, has there been any movement to raise the 18?
No, that's a state by state statute. Missouri is age 18. Other states are age 21, for example, but in Missouri, as long as I've known, it's been 18. Which is kind of scary, right? We were all 18 once. We thought we were mature. So Brent didn't even know this, but I was going to talk about this technique. This is one that he referred to in his presentation earlier with respect to a gentleman who wanted to leave some of his real estate to Missouri State. So there is a way to still enjoy the real estate during your lifetime, but make sure that upon your death, automatically by operation of law, the ownership, the fee simple ownership of the property would go directly to the charity. And that's by retaining a life estate. And you can do that with the preparation of certain deeds. Now, this would involve an attorney for sure. And it is something that you would get an income tax deduction for immediately. So that I want to differentiate this technique from, for example, naming a charity as a beneficiary of life insurance. You're not going to get an income tax deduction for that while you're living, because you can always revoke that, right? So this is a totally different technique. This is an immediate gift of the remainder interest of the real estate while you get the right to continue to live there during your life, or to use it to farm, those kind of things. So this is a relatively simple technique, but again, you would need an attorney to help you, but it is a relatively simple technique. I want to take a moment though, because Brent raised something when he was talking about this that I thought was extremely important, which is planning. So I do receive phone calls for people who are in the hospital or are suddenly saw the light and want to make a change to their documents. When I was a very young attorney, I would sprint to the hospital and I would help them. I don't do that anymore. There's just too much that can go wrong, especially if I don't already have a sense of that person's mental acuity, because I don't know what their baseline is. I don't know if they're on medication. Planning in a rush never works. And that's true about everything in life, right? We do much better if we don't procrastinate and we plan it out and we think about it when we're not under duress. We all make better decisions when we're calm and collected. That's not the case if you're close to death's door. We all know that. It seems obvious, but unfortunately it keeps happening. So all I can do is to encourage all of you, which I feel like I'm a little bit preaching to the choir, you're here, so that means you are being proactive. But even for those of you who have friends and loved ones who maybe are kicking the can down the road, so to speak, because It's not a pleasant topic, right? But it is so important to do now, and understanding that things do change, you have the ability to make changes later, but having something in place well before something happens to you is extremely important. So thank you for saying that. I could not agree more. And going to probate is the worst. So avoiding probate, that's another thing you can do with a trust and having proper beneficiary designations. You avoid probate, which is a huge plus for your family. Yes.
Is probate just when things are unclear and
Oh, thank you. I should have clarified what is probate. So probate is a process where after someone passes away, their estate is disposed of through a court proceeding. So it involves the probate court, which isn't the end of the world, but it's public, it's expensive. You're on the timeline of the court, for example. And so why would you go to probate? Your estate gets probated if when you die, you did not have a beneficiary designated on the asset. So it's maybe let's call a bank account with no POD on it, or a vehicle, or a 401k that you didn't designate a beneficiary on. So anything like that, that's in your individual name at your death that you don't have a beneficiary designated on, will go through probate. Thank you for that question. That was a great question. So I've referred a few times earlier in the presentation to some more advanced or sophisticated charitable techniques that involve trusts, one of which is a charitable remainder trust. Yes, this will involve an attorney. But essentially what this does is, I like to tell people, it gives you the best of both worlds. You can benefit your loved ones during their lifetime, but when they die, whatever remains in that trust will go to charity. And hence the name Charitable Remainder Trust, right? So that gives you, when that trust is created, you can create them during your lifetime, or you can create them upon your death. But when it is created during your lifetime, you get an immediate income tax charitable deduction for its creation, because you have committed. It is an irrevocable gift. I should have said that as well. This is not something that you change your mind on, okay? But when you create it, whatever that remainder is worth at that moment in time will give you an immediate income tax charitable deduction. Even though it might be 20 years before the charity sees any of that. Because perhaps you've said for 20 years, it will pay an annuity to you. It will pay an annuity to your spouse, your children, whoever you designate. But then when that 20 years is over, whatever's left in there will go to the charity. So it's a really nice technique because it allows you, it's called a split interest trust. It allows you to help non-charitable beneficiaries and charitable beneficiaries at the same time. And a lot of people that use this technique are people who, again, are charitably inclined, but maybe have a huge income tax liability that they're facing in a particular year. Maybe they've just sold a business, right? And they're going to have to write the government a huge check. And they say, well, I don't really want to do that. I would rather spend, rather than my government getting the money in tax dollars, which I'm not sure they're going to use the exact way I would want them to, I would rather give it to Missouri State. So I'm going to say, instead of writing this check, I want an income tax deduction, and I'm going to set that amount over into a charitable remainder trust. My kids can get money for 20 years, and then Missouri State will get the rest of their death, or at the end of the 20 years. So it gives them a very large income tax deduction. So this is a great technique if somebody's facing a very large income tax liability during life. Or upon death, this also gives them a large estate tax deduction. So we talked about estate taxes earlier. If someone's in the category of having an estate that exceeds that exemption amount, and they want to have a deduction, so they reduce their estate to below that amount, they can say, well, when I die, I want to set aside a large percentage of my estate to go into a charitable remainder trust to benefit my children, for example, and then Missouri State at the end of that. So then they'll get a large estate tax deduction, so they won't have to write that check for 40% of the extra excess. to the government. So there's a lot of tax advantages that you can have with a charitable remainder trust. Does anybody have any questions on that? Very high level on that one because it's kind of complicated. Okay, great. Something kind of similar to a charitable remainder trust is a charitable gift annuity. So this is something, Wendy, do you offer these here in Missouri State? Okay, great. So a lot of charities do offer, you can purchase it, and you're probably familiar with an annuity, right? You purchase it and you get money over time, right? It's the same thing, except at the end, when you die, rather than your kids getting whatever's left, the charity does. So you still get an annuity, but you get an income tax deduction during your lifetime, and you still get to benefit the charity upon your death. So this is a really handy technique. It does not require an attorney. It's something that you work directly with the charity on to purchase and find out what the various options are. But it's I think it's, to be honest, it's an overlooked technique, and I don't know why. I just don't think enough people are talking about it. But it's absolutely something that I would suggest that you consider. So if you have, you obviously have a charitable inclination, that's why you're here. So instead of buying a regular annuity, consider a charitable gift annuity next time too. All right, a charitable lead trust. I bet everybody can guess what that is. It's the opposite of a charitable remainder trust. So remember how I explained it was a split interest trust? And with the charitable remainder trust, we benefit non-charities first, like kids, and then we benefit the charity at the end. This is the flip-flopped. So we benefit the charity first, and then we benefit the kids or grandkids at the end. And it's a different tax technique. They work very differently depending on what the interest rate is at the time. Charitable remainder trusts make more sense, or charitable lead trusts make more sense. So it's really a tax decision more than anything else. I don't want to get too in the weeds on this, but I did want to explain that there is a different technique called a charitable lead trust. This will also require an attorney. And you can do these during your life or upon your death, just like charitable remainder trusts. Okay. I want to leave time for questions because I'm sure that you all came here today with maybe some specific things that you had in mind, or maybe more general questions about any kind of planned giving or estate planning questions as well. I'm happy to answer. And if there's anything online, just let me know as well with Zoom. No questions? It made perfect sense. Yeah. Okay, well, great. Well, thank you. I appreciate it.
Thanks so much, Emily. Really do appreciate it. Good information. I've got business cards on the table out there, so if you do need her contact information to connect with any questions you might have as you're headed home, feel free to take one of my business cards on that one. Also want to remind you all, if you want to do a watch party tonight in this room, doors open 5:30 for the Lady Bears tonight. So come on back if you want. Wanted to thank Deborah Goodwin for helping with this, and Angie Rowe as well. And so, once again, thank you, Emily, for this. So we are done, and go Bears.